The public sector workers were not going to relent in their negotiations with the government. They rejected a number of offers, insisting that they be compensated with an inflation-related increase. Delivering the February budget, Finance Minister Enoch Godongwana warned that the public sector wage talks posed a threat to fiscal finances, as they had not yet been concluded at that time. After trying its best to play hardball, government eventually surrendered, especially when faced with mass strike action that disrupted the provision of public services. As the Finance Minister warned, there are concerns about the sustainability of the public sector wage bill going forward.
Our understanding is that 37 billion rand is this year's cost of the wage settlement. From a fiscal forecast perspective, the net fiscal impact should be tempered somewhat by, firstly, the wage growth already factored into the budget numbers, and then the cash gratuity that falls away this year. However, when we're moving from a temporary cash gratuity to a permanent wage increase, it means that there will also be a cumulative effect in future years when the next wage increases will then be from a higher base.
The market will be closely watching to see whether National Treasury keeps to its word, that is, not to borrow for operating expenses like the public sector wage bill. While the local currency has been the worst performing emerging market currency in recent weeks, the public sector wage bill story has not been a major driver of this.
I don't think it's a significant concern based on the fact that the minister has reiterated the focus on fiscal consolidation, which essentially precludes borrowing to cover additional operating expenses, which of course would be seen negatively by the market and by ratings agencies.
Poor economic fundamentals, especially the ongoing debilitating high stages of load shedding, are threatening the economy's ability to thrive. A number of issues are expected to be definite headwinds for the country.
From a general fiscal perspective, the overspending on the wage bill relative to previous forecasts is only one of the disappointments. We're also looking at an economic growth situation that is probably more dire than expected at the beginning of the year, given the worsening of the electricity situation. And then commodity prices are even lower than Treasury's forecast at the beginning of the year, although Treasury has already been quite conservative in its assumptions, and that likely implies that company income tax revenues will disappoint versus what Treasury expected at the beginning of the year.
Despite the concerns raised, ratings agency S&P Global just recently kept South Africa's credit rating unchanged, including its outlook at stable. But economists are warning that this position may be short-lived.
The risk is that later in the year, should South Africa continue to see pressure on its state finances, potentially from weaker revenues than anticipated due to the impact of load shedding on economic growth, then the credit rating agencies may become a bit more negative towards South Africa.
Even if National Treasury is able to move resources around from other priorities to fund the additional 37.4 billion rand for public sector workers, this still spells a negative story for South Africa. Funds will likely be removed from important services like the healthcare sector and education, especially as Treasury pushes to reduce staffing and its associated costs. While projects that were earmarked for investment to help spur future growth may also be imperiled. Nompumelelo Siziba, SABC News, Johannesburg.